Global markets in CY 2026 have rallied sharply, driven by AI-led optimism, with markets such as South Korea and Taiwan benefiting disproportionately from strong earnings momentum in semiconductor and memory companies linked to the global AI infrastructure build-out. While these markets have delivered strong gains, India's underperformance continued as MSCI India lagged MSCI EM by approximately 30% CYTD. That a single Korean company is expected to surpass the combined earnings of all Indian companies sums this up very well. No clarity is emerging on possible resolution of US-Iran conflict and resumption of normalcy, as deadlock continues. This has led to prolonged higher crude oil prices, shortage of other essential commodities like gas, fertilizers, etc. Bloomberg Commodity Index has already reached levels last seen during the 2022 Russia-Ukraine conflict, driven largely by energy prices and supply-side disruptions. The rise in commodity prices has increased concerns around a second wave of inflationary pressure globally. Major central banks continue to remain cautious, with policy rates expected to stay higher for longer than initially anticipated. This scenario may accelerate the capital flows back to the source countries. India has been one of the most impacted countries in the ongoing geopolitical uncertainty. No major direct AI play, tariff tantrums, oil import dependency and relatively expensive valuations amidst slower earning momentum have all played their roles in keeping the markets under pressure over the last several months. This brings us to the core theme, down, but not out. While India has underperformed global peers in the short term, the broader domestic macroeconomic backdrop remains resilient. Key macro indicators continue to remain stable, with GDP growth expected at approximately 6.5 to 7%, CPI inflation still remaining within the RBI target range even as WPI has started to flare up, healthy forex reserves and a relatively manageable fiscal and current account position as of now. Indian corporate sector has shown surprising resilience compared to previous cycles. Corporate leverage has moderated meaningfully over the last decade, while corporate profit to GDP ratios are near multi-year highs at 5.3%, creating room for incremental investments. In addition, capacity utilization across industries is above long-term averages of 75%, creating favorable conditions for a private capex revival as and when the outlook improves. Record GST collections of 2.43 lakh crore INR. Rural recovery trends and resilient urban consumption are supporting broader demand conditions. The impact is increasingly becoming visible in recent corporate commentary, particularly within FMCG companies where management teams have reported significant volume growth. Prolonged range-bound markers have ensured that valuation concerns have also moderated. India's market cap to GDP has come down to approximately 115 in March 2026 from highs of approximately 144 in September 2024. In PE terms, Nifty 50 is trading approximately 7 to 8% below 10-year average forward multiple of 20.5x, and premium of mid and small cap compared to 10-year average has also come down substantially. Initial earnings signs have been quite encouraging, especially for the mid and small cap segment, as earnings are showing growth of approximately 25 to 30% on year. This earning trend has also been the reason for SMID and micro cap segment outperforming large cap by a significant margin in the short period since the beginning of the Middle East, West Asia conflict. The temperature gauge remains in the fair zone. This economic resilience amidst global uncertainties and complete FII apathy compels us to maintain our neutral view on the Indian equities with a relative overweight stance on mid and small cap segment while acknowledging interim volatility and frequent drawdowns. Portfolio allocation can be 50% hybrid or large cap, 40% mid and small cap segment and 10% global. Lump sum deployment in hybrid strategies and staggered approach for pure equity-oriented strategies are advisable. It seems appropriate also to draw reference to our beginning of the year view of Daedalus Way, or the year of moderation. This year we need to stick to our core allocations, not getting swayed by upbeat swings in the market nor be in despair when markets correct. This is the year of patient portfolio building, reallocation of capital at regular intervals while not losing focus of the long-term objectives. On fixed income, the RBI's commentary suggests that the rate cut cycle is now firmly on pause, with policymakers adopting a cautious wait-and-watch approach. Benchmark bond yields have softened from the April highs of approximately 7.15% to around approximately 7%, supported by some moderation in crude oil prices. However, the overall sentiment remains fragile, as any renewed spike in oil prices or weakness in the INR could quickly push yields higher again. At the same time, the OIS curve indicates a clear shift in market expectations, from anticipating additional rate cuts to increasingly pricing in a higher-for-longer interest rate environment, with growing expectations of eventual policy tightening if inflationary pressures remain elevated. Given this backdrop, we continue to remain negative duration and suggest cash flow-focused accrual strategies across the credit spectrum. Accrual can be played across the credit spectrum by allocating 55% to 60% of the fixed income portfolio to performing credit and private credit strategies, high-yield NCDs and income-generating assets like infrastructure investment trust. Remaining part of the portfolio can be allocated in relatively liquid fixed income alternative solutions like arbitrage funds, hybrid SIF funds and conservative equity savings funds. Gold and silver have been in a consolidation range since past 3 to 4 months after sharp gains in January 2026. Gold prices remain supported by central bank buying and demand from other sources. Further, speculative excess in gold has come down substantially. Gold net long at 41st percentile is below overcrowded levels seen historically. This means that the risk of selling pressures from unwinding of the long positions is limited. Silver, supply deficit is likely to persist for 6th consecutive year. Emerging signs of central banks buying interest in the silver and relaxed margin requirement may see price momentum building in silver as well. We suggest neutral allocation to precious metals, gold or silver with more weight towards gold.